I would say this. You don't want to think of it in terms of the broad 20-year horizon that's about to start. The day you buy the one share of Apple, you actually don't care about holding it for 20 years. That's not the major point of earnings per share. That's not important at all. Who cares that? It's not important that whether it's going to successfully do its 100 billion for the next 20 years. That you don't care about that. What you actually care about is that the market's expectation, the market believes, right? The market actually believes, if you buy one share of Apple, we think you're going to get 20 years of earnings by holding that share. And so you might look at the Apple stock and be like, man, these guys are going into Apple Plus, Apple Hollywood, Apple Health, Apple this. You're like, man, I think these guys are actually going to make their money way faster than 20 years. I think it's going to be 10 years or 5 years. Like these earnings are going to go up quickly. I need to buy this stock. Or you might say, no more iPhones, no more Macs. These guys, they're clowns. It's going to take 40 years to make that money back, or 50 years. I'm a seller.
So in essence, do I think the company can stay the way it is for the next so many years? Like, do I think it's going to be profitable?
Would you agree with that, JJ?
Yeah, absolutely. I think that's
exactly how you think about the stock market, right?
So, like, let's say I'm buying part of a company, and they're like the period of how much I'm buying up front is like 5 years, and they're like a startup or whatever. It's like, in the next 5 years, will this company still exist, and will it be doing as well as it is now? So if you think it is, then yeah, buy it. And if you think no, 2 years are going to fizzle out and slow down, then it's not worth it.
Yeah, or you can even short it. You can bet against it in a technique called shorting the stock.
Yeah, I've never messed with it, but I've seen it before.
Yeah, you can short it. Okay, so that was your favorite chapter, is explaining earnings per share.
Low key, that just blew my mind.
Yeah? In what way?
I mean, like, okay, I have like a decent amount of money in like Robinhood and Stash and like whatever.
This guy's got decent amount of money in Robinhood. He's driving a Porsche. Dude, do you really need a job?
Yes, I do need a job. I stop.
Okay, I'll stop.
Thank you. No, but when I understood that I had to invest, like, just because like, you want your money to make more money
long term,
like,
right?
And I just like understood that I'm buying like parts of companies.
Yeah.
But I never understood that that's like that's the reason why.
Yeah.
At the end of the day, it's
yes.
like, do I think that this company will last however much upfront I'm paying? I thought it was just like, this is how much the company is if you divide it up, and you're just buying it because the company might be worth more.
That is the basic understanding. This is the value of the company.
So I thought it was just that.
But the better, the deeper layer of understanding, which will help you invest better, is what JJ's explaining here. It's the number of years of earnings.
Like, it's like knowing how the game works, but knowing why you're playing the game.
There you go.
Like, dude,
you've just put this guy into the Matrix
now. Like,
he's in a Muslim Matrix. Right?
Like no. Now I'm gonna spend probably all of the night looking at like, this is like this much money. Do I really think that this company is gonna last for that long or whatever? Like,
well, JJ, you said there's a rating for this, right? Is that like available on Robinhood or something? Where they'll tell you the actual rating of how many years they're projecting?
Yeah, so you can look at whether it be on Robinhood or really anywhere, Yahoo Finance, anywhere that you get quotes, they'll have estimates for what analysts are expecting earnings to be in the future. They're just estimates, and analysts are, they tend to be a little bit overly optimistic. But you can get an idea of what people are expecting it to be, but more importantly, you can see what earnings have been previously. So you can see, is there a trend? Have earnings been going up by 20% a year for 5 years or for 10 years? Or you can see what they've reported, and it'll show it in a table format. And then, because the analyst opinions, I mean, those are forward looking. You have to take it with a grain of salt. But you can see what they've been doing, and I'm not saying that everybody that buys a stock values it on earnings this way, but this is this is one of the key ways that people look to value a company is by a multiple of those profits. It doesn't mean you're going to get paid back all of those earnings, because the price of the stock may go down if people don't want to pay as much for it in the future. The other thing to look at is you might be getting paid cash along the way if it pays a dividend as well.
Right.
And so that's another reason why you might see a stock that, it doesn't trade for a lot times earnings, but it pays a 5 or 6% dividend. Well, people are maybe owning that not because they think the stock price is going to go up, but just they want the dividend. They want the cash.
Yep.
So,
but yeah, you can go on any platform and look for the PE ratio. It's called. It'll tell you the number
That's
of
what
years.
it's called. Yeah.
So that number is just going to be like 20.
Yep. It's gonna be the average for like the S&P probably is around 15 to 20.
So, and then that would mean that they project the next so many years to be successful as to how much you're paying for it.
Yep. If you buy that right now, the market's expecting you to be able to recoup 15 to 20 years of profits from these companies you bought.
So basically, here's how the math works. If you have earnings, the earnings of the whole company, divided by all the shares, and that gives you that's your PE. You've got so your price per share divided by earnings per share, and then that if you flip it, that just tells you this is how many years up front that I'd be paying for.
Right.
And it's just a way to compare, because a stock that's trading for a PE of 10 versus one that's trading for a PE of 20, the market expects more from something with a PE of 20 because it's more expensive.